let's just jump right in. Today, we are unpacking a true heavyweight in the financial world. We're talking about Banco Santander. They are literally Europe's largest bank by market cap, currently sitting at a staggering 153.5 billion euro valuation. We're looking at an institution serving over 175 million customers across 10 core markets globally. In this explainer, we're going to look closely at exactly what is driving this massive machine, the totally unique advantages they hold over their competitors, and, of course, the pretty significant regulatory hurdles they're about to run headfirst into. Now, if you're thinking, oh, it's just another sluggish, traditional legacy bank, well, think again. Take this stock, for example, plus 53.9%. That is their massive one-year stock rally, which recently pushed them all the way up to an all-time high of 11 euros and 15 cents. I mean, this kind of explosive multi-year momentum in a European retail bank is incredibly rare. It completely shatters that stereotype of the slow-moving financial sector, right? It proves management is absolutely nailing something fundamental here. Which, naturally begs the big question for our deep dive today. Is it too late to get in? After a parabolic run like that, with the stock hanging out near its 52-week highs, is there actually any upside left? Or are we just showing up late to the party? To figure that out, we really need to look under the hood and see where all these profits are actually coming from. Section 1, the geographic engine. To really wrap our heads around Santander's recent success, we have to understand their foundation. It is built on a geographic moat that is practically impossible for their European rivals to just copy and paste. When we break down their profit distribution, it's fascinating. Most of their European peers are super tied down to one single domestic market. Not Santander. They pull in roughly 40% of their net attributable profit from Latin America, mostly through these massive operations down in Brazil and Mexico. Then another 40% comes from Europe, so Spain, the UK, and Portugal, and then 15% comes from North America. They are the definition of a truly global entity. So what this widespread distribution actually creates is what we call a natural structural hedge. Okay, in plain English, that just means if the European economy starts sputtering, or if Spain hits a localized recession, their fast-growing Latin American markets can just pick up the slack. They are structurally built to absorb regional macroeconomic shocks. When one area underperforms, the others step up and compensate. Actually, during the European debt crisis a decade ago, it was Latin America that kept them afloat. It's an incredibly durable competitive advantage. Section 2, capital discipline. But look, a massive global footprint doesn't mean much without phenomenal execution, right? Under the leadership of Executive Chair Anna Botín and CEO Héctor Grisi, the bank has rolled out a seriously lucrative strategy. Let's walk through their compounding capital return framework, because it is literally a wealth creation machine. Step 1, 5 consecutive years of dividend growth. Step 2, a highly disciplined, super reliable policy where 50% of their post-tax distributable profit goes straight back to shareholders, split right down the middle, 50-50, between cash dividends and stock buybacks. And step 3, just to give you an idea of the sheer scale here, in 2025 alone, they returned 7.05 billion euros to their shareholders. And here's where the silent magic of those stock buybacks really kicks in. Over the last 3 years, Santander has aggressively wiped out 13% of their total outstanding shares. Just think about the math on that for a second. Even if the bank's total group profit didn't grow by a single penny, their earnings per share would still climb significantly simply because there are fewer shares out there taking a slice of the pie. It's an absolute arithmetic cheat code for EPS growth, magically boosting profits per share just by shrinking the float. Then you couple all that capital return with their incredible efficiency ratio, 42.8%. That's their metric as of Q1 2026. In the banking world, the lower this number is, the better. It's how much it costs them to generate $1 of revenue. At under 43%, we are talking genuinely best-in-class territory here. They're operating so much leaner and faster than most of their massive European peers who are honestly often sitting bloated up in the 50 to 60% range. Santander is running a remarkably tight ship. Section 3, the regulatory storm. All right, so we've got this super lean bank printing money with 8 consecutive quarters of record underlying profits. Sounds like a total no-brainer of an investment, right? Well, let's pivot sharply here, because despite all those pristine fundamentals, there is a perfect storm of macroeconomic and regulatory headwinds coming in fast. It's not just one issue, it's a rapid-fire stack of them threatening their bottom line. They're dealing with a massive UK car finance compensation scheme. Over in Spain, there's an extension of the bank tax dragging down domestic profits, plus a new Spanish counter-cyclical capital buffer kicking in around October 2026 that's going to force them to hold more capital. Throw in stricter Basel III UK reforms, and top top the whole shebang off with Latin American foreign exchange volatility, that is a seriously heavy regulatory burden to carry. The absolute biggest elephant in the room is this UK FCA compensation scheme. We are talking about a £9.1 billion industry-wide contingent liability over missold car loans. Santander UK has already accepted the scheme, and collectively the industry has set aside billions to prepare. There is a critical tribunal hearing set for October 2026 that's going to determine how much pain this actually causes. Until then, it is a multi-billion-pound question mark hovering right over roughly 10% of the group's net income. And then, we've got to talk about the geographic paradox here. Remember how Latin America brings in over 40% of the group's profit? Well, what happens when your absolute best growth engine is also your most volatile currency exposure? The Brazilian real and the Mexican peso are famously volatile against the euro. So even if Santander's local teams in Brazil are firing on all cylinders and doing everything right, severe currency depreciation or inflation can literally evaporate those euro-denominator profits overnight. It's just the cost of doing business in high-growth emerging markets. Section 4, Verdict and Valuation. So let's bring it all together. To weigh this late-cycle valuation, we have the fortress moat on one side and this looming regulatory storm on the other. There is a massive tug-of-war happening with this stock right now. The bull case is all about absolute fundamental quality, best-in-class efficiency, 8 consecutive record quarters, and a 14.4% CET1 ratio, which just proves their core financial strength is rock solid. But the bear case? That's the undeniable reality of the market. The stock has already re-rated way up from its deep undervaluation days. It's trading at 95.7% of its 52-week high right now. Jumping in here means making a late-cycle entry right as regulatory uncertainty hits its absolute peak. So, when you look at all this objectively, the technicals suggest that chasing this massive rally might not be the most prudent move. With the current price sitting around €10.70, it's pretty late mid-cycle. Waiting for objective pullbacks naturally provides a much better margin of safety. For context, the first key support level, lining up with the 50-week moving average, sits down at €9.50, and a deeper, more structurally sound support level from the late 2025 baseline is hovering in the 8 to 8.50 range. Stepping in at those lower levels significantly mitigates those regulatory risks we were just talking about. Which honestly leaves us with one final provocative thought to chew on today. Do you have the patience to wait for the right price? Banco Santander is undeniably a global banking giant. They have an irreplaceable geographic moat and absolutely incredible capital discipline. But, as we know, smart investing isn't just about finding great companies. It's about evaluating them at the perfect time. Do you have the discipline to wait out the storm and buy this incredible institution at a genuine discount? Or is the momentum just going to be too tempting? Thanks so much for joining me for this explainer, and I'll catch you on the next one.